Hi everyone, John Hardy here, looking at some FX action this week, and I think it's a good timing. That's why I'm doing the video, of course, and I think we have a few interesting things going on here, especially lately. The big moves have been in dollar-yen on the result of those upper house elections in Japan and the anticipation of helicopter money in Japan. As you can see, the big rally in dollar-yen. You can see euro-dollar. The picture is not very interesting there, as both the euro and the dollar are weak, but not as weak as the Japanese yen. And on the stronger side, we're having especially Aussie and Kiwi and emerging market currencies. This is a weekly chart here in Aussie, so a bit hard to see how strong it has been locally, but it is looking at some interesting levels that you see this formation here. But we'll go through things a bit more systematically. Starting with euro-dollar, where we've had, of course, the Brexit reaction and subsequent consolidation bounce. Looked like we had a big bar here that was going to lead possibly to test lower. We saw U.S. payrolls last week on Friday, resulting in a really sort of long-legged doji, uncertain bar, which did not lead anywhere. And now it looks like we're trying to back up to the upside. And to me, the risks are a little bit leaning towards the upside. Now we've gone so long without the follow-through to the downside off the Brexit, and also considering how the Brexit has been unwound in so many places elsewhere. I think a key component, though, to see euro-dollar moving either way is going to have to be some sense that Europe is going to avoid this existential risks from the Italian banks, and that's a big ad hoc risk that is out there. And at the moment, both the euro and the dollar are looking a bit sort of middle of the road to weak, versus a resurgent sterling here tactically over the last couple of days, and with the risk appetite correlations not favoring either currency either. But let's look for a close below 110. We see that level etched quite clearly on the chart. So close below 110 is really a good indicator for the bears that we're going to be probing towards 108 and possibly the bottom of the range eventually. Those are my long-term expectations, but I can see a sort of relief rally and focus on the Fed never doing anything and strong risk appetite like we're seeing recently, resulting in another probe back higher and delaying that for who knows, maybe a quarter. Also, it could be uncertainty around the U.S. election. But let's take it one step at a time. That's the downside setup, 110, close below that. To the upside, we have a pretty clear area here around 112 and 112.50. If you look at Fibonacci's, it's somewhere sandwiched in between there on this retracement. Closing back up through there, I don't even require that much. I think if we're closing it back up towards 112, we're going to probe the old upside of the range and possibly beyond. So a very two-way potential there. Now let's run over to Euro Sterling, which is quite interesting. Last couple of days with the clarity provided by the new leadership coming on board in the UK. And here we have a bit of focus on the 84 area. I would say if we're looking at full sort of Fibonacci retracement levels, it's going to look more like 82 to 82.25. By no means are we out of the woods yet, and it's going to depend on how aggressive the BOE sounds on the dovish side on Thursday. They are going to likely cut rates. Again, this 82 sort of, the reason I didn't take this low is because it looks like a bit of a spike, and this is more stable low here, but it's all within 20 pips anyway, around 82, 82.25 for the first Fibonacci retracement. And on cable, we have, if anything, even more room to consolidate after the tremendous move from the 150 level. Here we're looking at something like 136.45, although I think the first keys before we can discuss that are whether 132 to 132.50 area holds, and then the 135 area, which was an area that found resistance just post the Brexit. Again, expecting lower levels here to continue. It's going to take an awful lot before we can call a reversal here. And 135 as well, by the way, is the previous low from the global financial crisis. So that's a big level, 135, if this local resistance can't hold the action, which I would suggest is a risk given this very strong risk-on environment, and the dollar not performing well in that environment in general as well. There's simply not going to be any new news of note for sterling besides Bank of England measures to impress with its ability to stabilize the financial system, etc. But in terms of what the Brexit means longer term, we're not going to be knowing that. We won't know that for months. They may not even invoke Article 50 according to the new leadership until possibly early next year, because a new platform needs to be agreed on before they formally request to exit the EU under their current relationship. So those are the key sterling pairs. I think before I switch over to some of the commodity currencies, I'd like to take a brief look at dollar yen because that is moving so much recently, and we've hit some key levels here. The first of those was the sort of 103.50 60 area, which is both the high here and then the previous lows. Those have been taken out. It's already starting to weaken the downtrend with such a move, forceful move. And then the next focal points are going to be 105 to 105.50. If we zoom way out to a monthly chart, I've put in the big Fibonacci levels from the all-time lows in 2011 to the highs last year, and we can see that this 100 spot 58, 50% area, and the 100 psychological level was critical. We see the 38.2 was a key level on the way down, and that it did find some support there. And if we look at the local setup here as well, we saw the 105 to 105.50 area, and here's the 106.50. So again, we've come so far down here, and if we have further anticipation, positioning is the wrong way around on these speculative positioning is the wrong way around on the yen pairs. More risk on, more anticipation of Bank of Japan could lead, even if we're going to stay in it within a downtrend, could lead to considerable further squeeze. And if we're breaking through these areas, we're starting to talk about higher levels still back towards 110, and you can start looking at Ichimoku cloud. Take one step at a time. We need for this move to extend above 106.50 before we can start calling a bigger reversal there. One other yen cross I think that is very interesting at the moment is Aussie yen, because of the, of course, those two currencies headed very much in opposite directions, providing polar opposites. As we're already bumping up against the key Ichimoku cloud level on the daily, this is also running into this big 80 area, which you can see is a very long-term area of interest for Aussie yen, which is one of those classic risk appetite indicators. And I would suggest if we continue to bull higher in asset markets globally on the easy Fed, accommodative Bank of England, expectations of Bank of Japan stimulus, this could remain an interesting trade, and we could be trading back towards the 85-86 zone, which is the previous zone of support back here in Q1 and into early Q2. So be aware of that pair as an interesting one, again, as Aussie and yen headed very much in opposite directions. And speaking of Aussie, again with the euro and dollar not so differentiated in this market, there's some interesting trades that creep up. Here's Aussie dollar. You can see on the weekly, this is a weekly chart, somewhat of a head and shoulders formation, shoulder, head, shoulder, although I don't really like those when they're slanting this much, but it does provide a trend line here, and we are poking at these highs that we're seeing some time back, just above 76, just ahead of the Brexit actually. In fact, if I go to a daily really quickly on Aussie dollar, we can see how the there was a run up. It looked like Aussie dollar wanted to break higher ahead of Brexit and was frustrated by the whole risk-off response to that. Now has overcome that, and to me this suggests if we sort of erase that Brexit happened, we're back to square one. This was around a key Fibonacci, which has been exceeded. I think it was just below. Well, I can pick it up here. That doesn't really matter, but it's been exceeded the 61.8, which is a classic throwback retracement area, 75-ish. That's been taken out, and again, if we're getting into this trend line, if we're in risk on, we're the market not fearing the Fed, this theme continues at least into the next CPI releases. I suspect the RBA is going to be really quick to start leaning against this move at some point soon. But technically looks like we could be set up for some kind of C wave. Actually, let me go back to the weekly, because instead of squeezing the chart so much, if this is an A wave, we're talking about Elliott wave sequences, and we saw these new lows here back in early Q1 when asset markets were falling apart. It's quite quickly rejected. We saw a very large wave. We could call it an A wave. Here's the B, and a C wave of equal size to the A wave actually targets 81.50, and I put that out in a note this morning. So let me try that again. I put my anchor down the wrong spot. Let's just try a new one. Fibonacci extension from here to the top of the B wave, and then we should create a C wave, the 100% extension coming in around 81.55-ish. and that would be 100% extension equal size to the A wave. So I think that's the kind of potential we're looking at. Would make sense on a technical basis. If we don't like the Aussie longer term, worried about China, global growth, and everything else, and the RBA eventually cutting rates, etc. But as long as the market is in this kind of mood, and we're pulling higher through these technical levels, it does look like the rally is very much on for now. And as well, the Fed seems thoroughly sidelined, and it's going to have to make a lot of noise and actually hike rates again to avert the impression that it can do anything. What else do we have? Another interesting one, I think, lately, or could be potentially interesting, Aussie related as well, is the Euro Aussie and Aussie Swiss, which are quite interesting because of levels and because of the theme of Euro weakness and G3 weakness in general. As you can see, this 145 area in Euro Aussie has been quite interesting, and we can see how far we've come up from the lows, and offers suggest there's plenty of room to the downside again if we're continuing with this risk-on interest in hard assets, gold, etc. Environment, and perhaps even more so in Aussie Swiss, as I'll show you Euro Swiss in a moment. If Europe can come to grips with its the banking system and bailing out these Italian banks rather than enforcing a bail-in, I think we have potential for Euro Swiss to head higher. And you can see the kinds of levels are coming up on Aussie Swiss here in the 75 area. And if I go to, actually I think I'll do it on the daily chart instead. If you go to the Euro Swiss chart for the daily, you can see that we're up to an interesting zone of 109 that was trading post or ahead of the Brexit. We saw Euro Swiss, a lot of defensiveness coming in. The S&P very much managed to defend the breakdown below 108, and then 109 is developed as the sort of area of resistance. We're poking on that too. Notice it's the 200-day moving average as well for Euro Swiss. So I think Swiss franc, even if you're not sure what euro dollar is going to do, I think the Swiss franc is going to be very vulnerable in this environment of strong risk appetite, and especially again if Europe comes to grips with its banks, and we get clarity on that front, we could be zooming back into this part of the range and possibly even higher further out if we see a better commitment to the European project from the powers that be in the EU. That pulled me away from the Aussie dollar focus, but Kiwi dollar somewhat similar to Aussie dollar, having faced a bigger rally because of its prior strength versus Aussie. That may be turning. We'll look at that in a moment, but we've again, it's similar with Aussie. We've come back and we're pushing on these highs that we're seeing just pre the Brexit vote. In Aussie's case, these highs back here were higher than the current levels, and in Kiwi's case, because the Kiwi's been so strong, we're actually new highs, and we have to zoom out to a weekly chart to get a sense of where the next levels are. And that's a bit dicey as Fibonacci retracements are so far away, and now that we've broken the 7230 level, we're talking about some much larger levels. So I prefer to focus on the round levels and would say 75 is the next key round level, and then we can see this area of traffic back here around 7750 as potentially the next key. Again, longer term, Kiwi dollar, just as with the Aussie dollar, very much a sell. There's lots of more rate easing that's going to happen in New Zealand. If we have this kind of currency strength, we're going to see it feeding into the CPI releases, which are very much in the crosshairs of the RBNZ. The next release is July 18th for that Q2 CPI. So watch for that as a potential turnaround area for Kiwi. And if you prefer trading away from the dollar, Aussie Kiwi is rather interesting as well. It's disappointed the bulls that were looking for you can see this enormous head and shoulders formation that failed to resolve. Neckline, you could call it, yeah, it's a bit messy, but around 113 to 113.50 area. That never resolved. There's been a new trend lower, perhaps on a real rates focus, because the RBNZ does have the highest interest rates and it has low inflation, so good real rates. But a bit hard to see on the weekly. I think more clear on the daily that we're seeing these local lows struggling a bit. If you put a momentum indicator on as well, you'll notice that of course, these new lows are trying to be rejected. This was on the Australian, this big bar here is on the Australian downgrade. So I think it's really showing strength if we can come back from the below to the pair after that Australian downgrade by the S&P bond rating agency. Let's put a basic momentum indicator on here like stochastics, and we can see it's harder to see on a slower indicator, so we'll take a lower frequency one like MACD and close our, and we can see that there's a momentum turnaround slowly unfolding here, and I think that you get better confirmation of that. You see the previous lows, oops, sorry, I dragged too far off the screen. The charts are not normally this jerky, is because we're using video, screen capture video at the same time. You can see the previous lows around 105 and a little bit higher. If we're pulling up above there, we're starting to see rejection of these new lows here, and Aussie could begin to finally outperform. Again, RBNZ has more potential to cut rates, and the Aussie is looking strong across the board elsewhere as well. So I think that'll do it. I think I've given a flavor of the different things we're focusing on. Again, the strength in the yen crosses on a weak yen, anticipation of BOJ easing. The market is the wrong way around. Speculatively, that squeeze could continue, also because it's partially being fed by the global risk-on theme on precisely the anticipation that we're looking to helicopter money, but also as the BOE is going to be very generous here, etc., and we're looking for that to drive more risk on until proven otherwise. Of course, if we see a sudden reversal, that the volatility has increased now, so with that volatility increase, if we do see big reversals, they're better quality than if we were seeing reversals in a sort of a low energy environment. So we just accept the action as it's manifesting now, and we'll see where it takes us in the days to come. Over and out. Until next time.